If you're an incorporated professional or business owner watching this video and you have retained earnings inside your corporation, there's one number that you really need to have tattooed in your brain: $50,000. And I'd be willing to bet most of you had never been told this number is so important. Canadian-controlled private corporations pay a dramatically lower rate on the first $500,000 of active business income. In Ontario, where I am, that's 12.2% versus the general corporate rate of 26.5%. On $500,000 of active income, that gap is worth $71,500 in tax savings before you've done a single additional strategy. It's the baseline advantage of incorporation. The question here is whether you're protecting it. When your corporation earns investment income, so that's interest, dividends, or realized capital gains, that's considered passive income. And the federal government has rules that reduce your access to the Small Business Deduction, or SBD, based on how much passive income your corporation earns in a year. So here's an example. For every dollar of passive investment income above $50,000, your small business deduction limit is reduced by $5. So as an example, at $150,000 in passive income, $100,000 above the threshold, the SBD limit is reduced by $500,000. So in this case, it's gone entirely. Your active business income is now taxed at 26.5% instead of the much lower 12.2%. On $500,000 of income, that's $71,500 in additional corporate tax annually, year after year, without any obvious trigger. The CRA doesn't send you a warning. Your accountant might catch it at year end after the damage is done, or they might not even catch it at all. The most common mistake I see is retained earnings sitting in corporate savings accounts or GICs generating just interest income. That interest, of course, counts towards the $50,000 limit, dollar for dollar, and a $1.5 million corporate portfolio, let's say earning 4% in interest, would generate about $60,000 in passive income, which of course is $10,000 above the threshold, and of course eroding the small business deduction. The second most common mistake I see in a corporate investment portfolio is that it's too actively traded. Every time a capital gain is realized, it counts as passive income. High turnover active mutual funds inside a corporation are doubly problematic. Not only high fees, but also passive income generation that eats into your SBD. So here's how you can manage it. First, you might want to connect with a financial advisor to consider shifting into a lower turnover, broadly diversified passive equity portfolio. Unrealized capital gains don't count as passive income. A properly structured portfolio built on low-cost index funds can compound inside your corporation for years without triggering your threshold. Second, you might want to consider maximizing your personal registered accounts. Your RRSP and TFSA growth, of course, doesn't count against the corporate threshold. So every dollar growing in a registered account personally is a dollar that does not create passive income inside your corporation. Third, you might want to consider a holding company. An OpCo and a HoldCo each have their own $50,000 threshold. So dividends flow from OpCo to HoldCo under the intercorporate dividend deduction with no immediate tax. Two corporations, two thresholds, more room to invest before the SBD starts eroding. And number 4, you might want to take a look at your IPP or individual pension plan eligibility. Corporate contributions to an IPP are a deductible expense, which reduces the retained earnings accumulating inside the corporation in the first place. It's not for everyone, but you might want to consider this as an option for your future. This is exactly the kind of thing that falls through the cracks when your accountant and your financial advisor aren't talking to each other. It's not a criticism of either of them, it's a coordination problem. And coordination is exactly what I do. I'm Harry Sale, financial advisor at Raymond James in Toronto. I work exclusively with incorporated professionals, business owners, and their families across Canada. If you want to understand where your corporation stands against the $50,000 threshold and what to do about it, the link to book a call with me is in the description.